Today we have the pleasure to have Maha Al-Sari. Maha has been, has 16 years of experience in financial services and compliance and regulatory affairs, while she was working with Qatar Financial Center Regulatory Authority and the Deutsche Börse and Trade Republic Bank, among other entities. She currently works in compliance and regulatory affairs. She's the director of this department at the Bank House Scheid. Probably Maha can pronounce it better later on. Maha also worked on the adoption of the European digital package, including the MiCAR and the pilot regime, and she has been involved in the implementation of the German Electronic Securities Act. So today she's going to tell us a little bit more about her work and how to navigate the compliance landscape from the digital, like the difference between the digital assets and the traditional financial system. So Maha, thank you very, very much for joining us. And now the stage is yours.
Thank you so much for having me. So I decided that I don't want to have a very typical slide with a lot of text on it. I'll try to make it as interactive as possible based on my experience on basically what's happening on a day-to-day kind of environment from a compliance officer point of view. So I will start with the slides. I would basically see that there are three major challenges that a compliance officer is faced with in a crypto environment. So working for a regulated bank that has a MiFID II license and is fully regulated, of course, regulatory clarity around the adoption of crypto assets is a major pain point. We do have a framework around it, but when it comes to the details, as we will see later, it is an issue. The constant change is an issue, and finding the right talent. So in this presentation, I'll focus on the very first one. Within regulatory challenges, these are the things that really popped into my mind when putting this presentation together. We all know that KYC AML is one of the first things that was regulated when it comes to the adoption of crypto assets. So with the FATF recommendations, we know that virtual asset service providers should be registered, that we have to apply the travel rule requirements. That is all good and great. But we have certain restrictions that we have to make sure that we're applying, be it the prohibition of using privacy coins or anonymous coins, mixers, even though they're not always used for bad purposes, but this is a complete ban of such coins. We decided to be very cautious when it comes to dealing with self-hosted wallets and only use them if absolutely necessary. Because of all of the requirements that have to be applied from an unhosted wallet perspective, be it from the travel rule perspective or the information that needs to be adopted. You might have seen that the 6th anti-money laundering regulation, or the AML package, was recently voted on and adopted at the European Parliament. And now we also have to include NFTs, DeFis, and DAOs that could be sourced to a particular entity or a person. This will also be part of the AML regulated requirements. So I'm really curious to see how that would work. It's kind of unfair that the threshold applied for crypto assets or cryptocurrencies is 1,000 compared to to fiat payments, which is 7,000. And in this case, it's basically making a statement that crypto is 7 times more risky than fiat. And I beg to differ because there we have a trail record of what's happening. Add to that the analytics tools that we have to apply to analyze the KYA or the KYC transactions are pretty costly. And you need specific training to deal with them. So how would you look into the different hops, or how would you know if a coin or a transaction is really tainted? So that would require specific training, and the majority of these services are not very cheap. Applying ongoing monitoring is another issue that I'm facing when it comes to AML. How would I know that the person behind the wallet remains a person behind the wallet? I have no control over that. So you always have to have these assumptions in mind that you cannot ensure 100% compliance. So yes, we will have a European framework going forward, and hopefully with the AMLA, we will have a European regulator. But still, on a national level, we have so many divergence when it comes to AML and KYC. The second issue is tax treatment. In Germany, we have very clear requirements when it comes to holding crypto assets for a certain period of time. So if you hold crypto assets for a year, you don't have to pay taxes on them. But we still need a bit more details on the wholesale treatment of taxes. We are also looking very actively on the DAC 8 or the Directive on Administrative Cooperation for Taxes, which might be putting forward a harmonized tax regime for crypto assets. I personally would love to see it happen, but seeing how national jurisdictions are super picky when it comes to their taxes, I doubt that we will find a lot of progress, but I really hope that I'll be mistaken on that. Regulatory reporting is a big issue. I mean, we know a lot of requirements when it comes to MiFID, to EMIR, you have pre and post trade transparency, but when you're dealing with crypto assets, currently you don't have a lot of clarity around how reporting would look like. Very recently, with the adoption of the DLT pilot regime, we know that we should be adopting, I don't know, the DTI, the Digital Token Identifier, that will come on top of the ISIN, but this would primarily assume that it's a security token. But how are we going to be dealing with specific cryptocurrencies? If you look into the EMIR refit, you would see that derivatives that have crypto assets or cryptocurrencies as an underlying will be adopted. That is only for that particular purpose, but the majority of cryptocurrency trading still have a bit of a tricky way to be reported, and we would need a bit more clarity on how that would look like. And we know with MiCA coming up that we would have to satisfy certain requirements in terms of reporting, and it's totally blurry as it is right now. Another aspect is the authorization and licensing. As mentioned at the very beginning, we know that the FATF requirements impose the requirement to register crypto asset service providers, or VASPs in that case. And the authorization and licensing requirements vary very, very much from jurisdiction to another. Some of them could be seen as more lean, and the others are very restrictive. Of course, some will require to having, I don't know, an MLRO physically on the ground or register an office, and the others would be okay with very easy registration requirements as opposed to an authorization and supervision. And in our case, we decided to stick within Germany because we know that we have a lot of regulatory clarity from BaFin's side, and the requirements are clear. Another aspect that I would touch upon is the prudential treatment of crypto assets. You might have seen the BIS paper on the prudential treatment of crypto assets, where they have really put a very difficult risk weight on crypto assets that classify as Group 2. These are pure cryptocurrencies, and the weighted risk average is 1,250%. I think that is really difficult to maintain. And this will be enforceable in Europe, I think, on the beginning of January 2025. So this is an issue that leaves us with very little room to wiggle. Another aspect is, of course, risk management. I'm not a risk manager, but in a lot of cases, compliance and risk management have to work very closely together. And there we know that liquidity risk is a major one. Counterparty risk, you could be dealing with one entity that will cease to exist the next day. You never know, like with FTX and the likes, we thought that you have one of the biggest markets, and all of a sudden it ceased to exist, and bam, it's gone. We should not underestimate the reputational risk. So as a regulated bank dealing with crypto asset providers across the globe, we need to make sure that we do not have any headwind when it comes to operational risk, because then, reputational risk, because then that could have an impact on our license, on the way that our trusted clients would be looking into us. So this is huge in the crypto industry. Regulatory risk, because we have constant change, as we will allude to later on, and FX risk, if you're looking to convert crypto to fiat and vice versa. Sanctions is another topic that I'm struggling with, to be frank. I mean, we know that we have sanctions lists that are provided on a national level. So the Bundesbank in Germany will send some newsletters. But these sanctions, whether listing the entities or the individuals, are usually referring to an entity as a corporate or a natural person. But when you're dealing with crypto, sometimes you really need to go to the US approach and start looking for sanctioned wallet addresses like OFAC does. So we don't have that, and we don't have that on a European level, and it will be super helpful to match sanctions with wallet addresses going forward to help us with the automation. Marketing and promotion. Maybe some of you have seen the recent warning that BaFin issued Uniswap, because they tweeted something in German and they immediately said that this is active marketing and promotion to the German clients, and they don't have a license in Germany, and they got basically a warning saying that this is not allowed. So we are, for example, a MiFID II regulated bank, and we are allowed to passport our services across the EU 27. That is for traditional business, so for the normal financial instruments. After having conducted a very thorough analysis, I realized out of the EU 27, I can only tackle 2 countries with active marketing for crypto assets, and the other 25 are out of scope, which is kind of unfair because I can do it for traditional securities, but for crypto, it's always this keep your finger away from it. It's dangerous. It's you have to have these extra requirements on top. So you have to be very, very careful when it comes to marketing and promotions. Of course, it's a different story if it has to do with reverse solicitation, if someone comes to you and then you can onboard them, but you cannot really have active marketing and promotion to make use of your products and services in the crypto industry. Jurisdictions and countries, basically, this is something that I'm also struggling with. The majority of the real good liquidity providers or exchanges that I would like to deal with from a liquidity provision point of view are located in jurisdictions that are on a tax havens list, a high risk jurisdiction from an AML point of view, or a sanctioned list. So my possibilities to deal with regulated entities within the EU, for example, are so limited. And it's sad that I don't know, just immediately onboard someone from the Cayman Island or Gibraltar, where they have excellent service providers. But currently, with all of these restrictions, it's very difficult to onboard, and it will increase our risk weight in front of our regulator. So I hope that we'll have more and more regulated players within the EU to resolve this problem. Market data is an issue. So there are excellent market data providers for crypto assets, but once you're dealing with crypto assets trading and you have to have an interaction between crypto and traditional business, I can only think of actually 2 providers, and this is not a promotion, it's just like based on my experience. Kaiko and Nasari are the only 2 that comes to mind when it comes to real reliable data to satisfy crypto, but also traditional business interest, because they have the most valuable market data that I can use for both traditional and crypto. What I would love to see is similar to the beneficial owner registry on an EU level, possibly a VASP or a CASP registry, where I would know all of the registered crypto asset providers within the EU, or within equivalent jurisdictions that I can be dealing with. Because right now it is really a manual effort to go and start looking at who is offering what, are they reliable. You hardly have any track record of a company for more than 2 or 3 years, and that will make it very difficult to decide if you want to onboard them or not. Another issue is segregation of accounts. We need to make sure that we keep our accounts separate from our clients, and that each client would have an account that is independent of other clients. Great in theory and very much necessary. But if you're dealing again with fiat and crypto, you would have to have an Ombus account for your traditional business, and then you would have to have separate wallets for your clients. Would they have to be on chain? Do they have to be off chain? How do you secure them when you're not really providing the custody service? So in our case, we're doing OTC trading and liquidity provision and market making. How would we make sure that we provide a proper segregation of accounts of clients that we're not holding their accounts on their behalf? Do we deal with custodians? Do we have to have something on chain compared to something off chain, or do we just deal with regulated custodians on both ends? This is still a bit of an issue, and we're trying to find more regulatory clarity on that. It is going to be definitely a requirement under MiCA, but the current text is super blurry, and I hope that it will be clarified within the RTSs and the ITSs going forward. There is a good guidance from the state of New York. They have issued a specific guidance on that, but it was primarily focused on custody services. Good practice, lesson learned. It's so important to have an insurance coverage in place for your crypto activities. So you need to make sure that you have an indemnity that will either cover gross negligence, cyber attacks, ransomware, because you never know. You never know when something could happen and how much it would cost. There are a number of insurance providers that can provide such indemnity, and it will be really a good thing to have because it will reduce your exposure dramatically. Looking into MiCA, something that a lot of crypto asset service providers are allowed to do now and will not be allowed to do in the future, is borrowing and lending and using interest as gains, like interest gains. These two will most likely be stopped once MiCA kicks in, because there's a prohibition of interest gains on crypto assets. And again, I think for traditional regulated industries, or for the crypto industry in general, this is slightly biased and limiting when it comes to product innovation. And I'm hoping that this will be revised within the final text that we will see in a couple of days, or at least once the European Commission puts its report after 3 years on the performance of MiCA. But this is going to be a huge showstopper. Cybersecurity, of course, you know that you have to have measures in place. We have the Digital Operation Resilience Act in place that will enter into force in 2025. But let's face it, the way that crypto assets and DeFi and smart contracts are formed, there's always a chance for vulnerability. And this links to my point previously on insurance and why it could be very useful to have, because hackers and cyber attacks are always a step ahead of the curve, and you will never have 100% coverage because we're still maturing and we're still learning, even as a bank with over 40 years of track record. I will then move to outsourcing. When it comes to crypto assets compared to traditional finance, you know that within crypto, we rely heavily on partnerships and outsourcing, because you cannot do everything on your own and someone can always do it better, and you need certain elements from other crypto asset service providers. But again, looking into DAWRA and looking into the requirements around outsourcing, it is very, very difficult to maintain a proper outsourcing arrangement with the current regulatory setup. You have to identify if it's material outsourcing or not, if you have auditing rights on the ground compared to your outsourced entity. How would you maintain the responsibility for something that you're not necessarily a subject matter expert on, but you kind of need it? So outsourcing is pretty difficult compared to traditional finance, where you have certain parameters and you know what to look out for. But in an industry like in crypto, also from a banking perspective, you rely a lot on it, but it is very difficult to get approvals and to ensure that you have proper SLAs in place. Working in crypto for the past, I don't know, 4 years, every time I see a regulatory guidance, it primarily focuses on custody, which is great because it's safekeeping of clients' assets and you want to make sure that this is protected, etc. But when it comes to other use cases, you hardly find any real direction. So when it comes to trading, when it comes to propriety trading, market making, liquidity provision, dealing with the secondary market, how would it look like with ETFs and ETNs? So we're in desperate need of additional regulatory guidance, which steps beyond the custody services. And of course, beyond the typical, it's risky, it's volatile, and the typical regulatory guidance that we see from our regulators and standard setting bodies. One additional aspect that is currently tricky is audits. We know that we need to have certain audits rights when it comes to proof of reserves, proof of liquidity. What else you have? Proof of funds, auditing a smart contract, auditing the Digital Operation and Resilience Act provision when it comes to ICT providers, etc. But in a lot of cases, and after what happened again with FTX, unfortunately, a lot of audit firms decided to step out from their audit mandates. And there is a huge lack of that knowledge and of reliable audit firms that are willing to audit you as a crypto asset service provider and come up with a statement because they would see that as a risk. Reserve and liquidity was something that we spoke about previously. How do you make sure that your counterpart has sufficient liquidity and reserves if that entity did not exist for so many years and you cannot look into their account statements for 3 or 5 years like a traditional business? You don't have an auditor that would testify for them. And you would need some sort of a rubber stamp to satisfy your regulators that you're allowed to engage with that entity and you have performed your due diligence properly. Best execution is another thing that we have to satisfy when it comes to trading. And if I have very limited numbers of venues that I can operate with, because all of the restrictions that I have from a jurisdictional point of view, if I cannot deal with the Cayman Islands or Gibraltar, and I only have, I don't know, 1 or 2 regulated entities in Europe, you could argue that I might not be able to provide my clients with the best execution because I don't have access to a lot of proper venues to compare prices from. And this is going to be very interesting also once MiCA kicks in, because right now it's just stipulated in one little article and there is not a lot of information around it. So I'm really curious how best execution would look like once MiCA is in place. And market surveillance is another topic. Here, we have to make sure that the same things that apply for prohibition of insider trading, application of the market abuse regulation and directive, that you have to ensure that there is no price manipulation or so whatever. And that is kind of important, but again, you're still learning as you go when it comes to crypto assets. And a very good example of that is what happened with Coinbase and the insider trading case opened up an additional basically gate to hell to see how that would work for crypto asset service providers. And it could be important to work with outsourced entities here again, like analytics tools to see how you can make sure that you have the right market surveillance. Would you ask your traders to stop trading certain currencies, for example, and they might still do it on a decentralized exchange and you don't really have an oversight over it. So that is going to also be more and more important going forward. We know that the regulation is always there, starting always with the motto that it's there to have investor protection. Perfect. But when everything happens, let's say with hacks or with FTX or other exchanges just that went bust, like Celsius and the like, even though some of these entities were regulated and supervised, the investor protection did not kick in because you do not have the typical deposit insurance that you would have in a traditional business. So in Germany, for example, if you have a deposit in a bank for 250,000, you can claim it back. You don't have that for crypto, even if it's regulated. And it's a bit unfair because if I would choose to work and put my keys with a regulated crypto asset service provider and something happens and they don't have a proper insurance in place, then my tokens are simply gone. And it makes me question, why should I have a regulated crypto asset service provider if I don't have the same amount of protection compared to my deposit insurance scheme for a traditional fiat account? Settlement is going to also be more and more interesting. In traditional business, you have T+2 settlement. So for your traditional security tokens, for example, you still have to go through T2S and wait. But when it comes to pure crypto, we have instant settlement. And at a certain point, these two will clash. And this is where we'll definitely need to have more clarity around programmable money and smart contracts dealing with crypto and instant settlement. A good example of that is what happened when the Silicon Valley Bank also went bankrupt. You saw that Circle depegged because you could withdraw your accounts 24/7, whereas you had the weekend to think and reflect while the regulators are making the decisions for you before you can take your deposits from Silicon Valley. Or deal with them. So here you have the clash between the instant settlement, instant withdrawals for crypto versus the 5 days a week, 9 to 5 opening hours for traditional institutions and banks. All of this makes compliance super costly. And in a lot of crypto asset banks or institutions, compliance is still seen, unfortunately, as a business prevention unit. The management and the sales guys and the business development and product development guys know that they need compliance, but the compliance culture is still a bit difficult to, let's say, put together that awareness because it's seen as a bottleneck, as another cost. And it's constantly questioned in a lot of crypto asset service providers kind of businesses. And it's kind of unfortunate, but it is the sad truth. And I hope that this would be seen as complementary to the business as opposed to a pure cost. And yeah, from my point of view, there is constant change. I mean, I swear to you, on average, I spend an hour and a half every single day just trying to track what regulatory changes have happened, be it on a national level, European level, or standard setting bodies level. It is a lot to grasp. And then trying to clarify how would that impact you, the assessments around it. It is extremely interesting, but it's very challenging to keep track. And sometimes you also have to be very creative in the sources that you have to get data from and information. Of course, you can always sign up to your typical regulators' newsletters, but I personally find Twitter, for example, and Reddit as very valuable sources to track some of the regulatory changes based on the community feedback. And usually you would get the information faster than any sort of news outlet. And here you can see a quick look of some of the sources that I have to literally, physically, manually track every single day. So this is just to name a few, and this is only for Germany. And the moment that we want to expose ourselves to other European jurisdictions, you can add 2 or 3 more boxes per country. And finally, what is very difficult from a compliance regulatory affairs point of view is finding talent that is willing to work in such an environment. Of course, they would tend to work or opt to work for bigger names or established institutions. But if you're working for something that is smaller or a startup, talent in regulatory compliance is super scarce and very difficult to find. So I think it's a good area to be in, and it's super competitive. And by that, I conclude my slides. I hope that I did not bore you a lot with details. I tried to keep it as high level as I can and based on my day-to-day operations and my pain points. So thank you very much.
Thank you, Moha. Actually, it was like really interesting. I was just like taking notes of some of the topics that you referred, and also I agree a lot with some of the comments that you made about the difference regulation between crypto and fiat currencies right now. I have a couple of questions, but I want to first give the opportunity for the community to intervene if they have any questions. So, does anyone want to make a question? Okay, then I will go directly with my questions. So, Maha, you were like talking about the new AMLR regulation that we saw last week. We also did comments to different parts of the regulation, among them the one that you highlighted, which is the difference between the thresholds of cash, which is 7,000 euros, and crypto going down to 1,000 euros for the transactions between self-hosted wallets. We of course understood how like the same reading that you have, that this is the regulators understanding that crypto is more prone to money laundering than cash, even though when the report says otherwise. But then I wanted to ask, what kind of measures are you taking on your organization to try to move the needle on the regulatory bodies to actually understand better, or leave a little bit the fear that they have when they hear the word crypto?
I have to admit that BaFin is very approachable. It was one of the first regulators that put together a framework around crypto. So we are lucky. Of course, there are other jurisdictions like France that is even more crypto friendly, in my opinion. But engage, and it's a lot about educating and making a case. And let's not forget that our regulators and our supervisors are public servants, and we have the obligation as a community to also voice our concerns and let them know where we are coming from, and come up with very good use cases as to why crypto is not dirtier, if I may use, than fiat currencies. And a very simple example that I always throw in the room is you have crypto that is more or less very, very transparent, and you could always have a look into what's happening from a transaction point of view. If I throw a bag of cash somewhere, nobody will be able to trace it back to me. And this is really unfair when it comes to that 1,000 versus 7,000 euros comparison from crypto to fiat. I think cash is still the ugliest thing that you could do illicit transactions with, and crypto always has a way to be traced. So the transparency around it is the biggest winning argument here.
Totally, I agree with you. There was another thing on the AMLR last draft that you also mentioned, more or less, that is the change of reference to the wallet to the addresses. So now the regulatory bodies are interested actually in understanding who is behind the addresses that are executing the transactions. My question for you will be if you know solutions out there that are now working on this particular challenge on how to identify who is behind, and what have you seen out there, especially because privacy has been one of the key components behind the blockchain and the crypto space that like we want to protect. And now there is like this in between approach where we would like to have or like understand who is behind the transactions based on risk. So not everyone opening, but like when we want to open the box and see who is there, because there is some risk of AML happening. How can we do that?
I have to admit, like, my focus is primarily from an institutional point of view, so we hardly deal with any sort of retail KYC or onboarding elements. That said, I saw that there was a startup in Ukraine is developing some sort of a solution around that. I cannot remember on the top of my head the name of that entity, but they claim to be GDPR compliant, and they claim to be able to satisfy this requirement from a KYC, AML, GDPR, and also only revealing what's super necessary. Another aspect that I was just thinking about, and it just popped into my mind, where does the digital identity discussion kicks in? Would that force us to have better DI and SSI to ensure the anonymity? I mean, that could be a way forward if you have disposable identities and you'll be able to only reveal what is super necessary for a transaction. I don't know. It's a very difficult question to answer, to be frank.
It's not an easy one. I just was curious if you know, because we are exploring solutions in that area where you can actually do KYC via tokenization, so you can actually have like certificates of and change and on change, so you actually
Yes.
respect GDPR, which is I think the direction to go right now. But yeah, once we have more information about that, I will for sure forward it to you.
I would love that.
I'm glad to hear. I guess my last question is regard to the licensing, because you mentioned there is, sorry, we have like now MiCAR, which will gonna give like European standards, but there is always like these adjustments at the national level. Do you actually like see like this licensing part as one of the benefits or MiCAR? Because once you get a license in one of the European countries, like it technically will apply to all of them, or you still foresee national regulation putting some requirements on top?
So for the time being, I think that the treatment of licensing and supervision on EU level is super diverse. I did a high level assessment to all EU 27. In certain cases, you did not only have one authority, but you'd have to deal with two. Some would require you to have a person on the ground from an AML point of view. The others would require super high capital requirements and investments, and the other you would just have a registration, say, within 3 to 4 days, and basically just submit a business plan and a few forecasts, and then you're done. From my point of view, MiCA is going to be a game changer, and it provides a very welcome change around the EU passporting. And what we're doing in my current bank is waiting for MiCA to activate that, because it's very costly, very time consuming to have a license per country at the time being. And we'll just wait until we have MiCA in place. And the fun fact is, if you are a regulated financial institution, be it an investment firm under the definition of MiFID or a credit institution, you do not have to apply for a fully fledged MiCA license. You'll just have to notify your regulator 40 days in advance of conducting crypto asset services. And this by itself is a huge advantage for a lot of the incumbents, a bit of a disadvantage for the pure startups that are looking to provide their services. And if you're already authorized in your national jurisdiction to provide crypto asset services, don't worry, you have an 18-month grandfathering phase. So you would have enough time to comply with MiCA once it kicks in, and then you'll be able to also passport your services across the EU 27.
Makes a lot of sense, actually. I want to give the last chance to everyone else to, if you have any question.
I would have maybe one more question, Maha. So I've been reading sometime things like how can traditional finance or how can actually crypto learn from traditional finance, especially when it comes to like kind of stress testing and implementing that into crypto. What do you think about that? What is your opinion about that?
That's a very good question, actually, because I read a BIS paper that says that DeFi is just an illusion, and another one by IOSCO that says that basically DeFi is replicating everything that's happening in traditional finance. And I found these statements slightly biased. Of course, there is a lot to be that the crypto industry can learn from traditional finance, only to make it better and faster and more efficient. Because traditional finance, yes, it's been there for ages, and we have all these regulations around it from the financial crisis in 2008 and 2009. But we've seen, for example, in the case of Credit Suisse, that issues still happen in traditional finance regardless of high regulation, high supervision, etc. I believe maybe if I may, I would say that traditional finance should learn from crypto, not vice versa. Maybe I'm a bit biased, but I've seen a lot of efficiencies in crypto. The only thing that I'm a bit worried about is the cyber resilient part of it, and the ransoms and hacks. Other than that, I think that traditional finance has a lot to learn from crypto.
Now that you brought that up, and I just remember that you were talking about France before, might be too new, but there was a call today done by the Banque de France, which basically is like trying to say if DeFi is decentralized or actually disintermediated. Have you seen this paper, or like it would be really good to hear your position?
Was it by the deputy governor of Banque de France? It was published today by the BIS.
Yes.
Yeah, it was on my reading list. I haven't done it so far, but I think he was basically saying that he was criticizing private blockchains to a certain extent, right?
I started to read it as well today, but
Yeah.
basically, I think that like it's basically like Mika 2.0 is coming for DeFi, and actually like they are criticizing, or they have an interesting point of like the level of decentralization and how much is decentralized, or if it's actually just the lack of like this intermediary part. Like if DeFi will be DeFi without the intermediary, and therefore, if that is the only level of decentralization that you will need to actually call something DeFi, and if that is the case, then it's not completely decentralized, and then you should have a second level of legislation.
Oh my. Okay, more work for me. Yay.
Yeah. When you read it, like, please let me know what you think. Like, really curious to see how you see the paper.
Yes, it's on my reading list for this evening.
Awesome. Well, last chance, everyone. Yes.
Yes, great. Thanks. I didn't get the whole presentation, but after all, I would just ask the question about Mika and startups in this regard, because it seems like Mika is like an approach to make it possible for banks to enter the market, or institutionals to enter the market, but it's also make it harder for startups to fulfill all the rulings. So what do you think in this regard, if the startup scene will get out of Europe, or is it fair, which is written down in the regard of licensing? And what do you think about it?
Let me put it this way. Traditional players or regulated banks currently will have it much easier than startups. Being startups and having all of the issues around funding and costs, will have a higher cost of compliance. That said, I would not say that MiCA is forcing crypto asset service providers out of Europe. We've seen at least we have a regulatory framework and a bit of regulatory clarity on what to expect and how to approach crypto assets. With all due respect, compared to the US, which is taking a very harsh enforcement point, and even some might argue it is stopping banks from offering crypto services to a certain extent with on the light of what happened with Silicon Valley Bank and Signature Bank and the likes. Europe is taking a cautious, strict approach, but I don't think it would result in killing the startup scene in the crypto industry. It will just make it more compliant and more difficult as a gatekeeper. I don't know if you've seen some of the announcements that were done by Circle and Coinbase saying that they would welcome what MiCA is doing. Circle said that it might open up an operation in, what was it, in France. So having their European headquarters in France. Coinbase alluded to the UK and maybe Ireland, if I'm not mistaken. So bigger players will have it easier. Startups in the crypto scene will have more costs, but they would also have the approval of a very strict European regime. And as mentioned earlier, you can passport your services to the entire EU. So it might be cost well spent.
Thanks.
Welcome.
Any other question? Okay, then Maga, again, thank you very much for giving us your time. I know that you're super busy, so we really appreciate that you give us this hour to hear everything about your job and all the challenges about compliance and regulation right now. For the rest, as you know, and for those that missed the beginning of the presentation, a part of them we were recording and we will share them with the community in the Discord regulatory channel as soon as possible. So thank you everyone and have a nice Easter break.
Thank you,
See you next
everyone.
Thank you so much.
Thank you.
Have a great
Bye-bye.
Sunday. Bye.
Bye.